Yes.
Good afternoon, everybody, and welcome to the TSP Tax Update Webinar on the 16th of October 2024. I'm Jeff Webber. I'm one of the tax line consultants, and I'll be your chairman for today. Today, we're covering two main topics. The first one will be the benefits of using alternative dispute resolution, or ADR, where our speaker is our colleague Jack Sloggett from our tax dispute resolution team. And the second main topic will be demergers, where the speaker will be my tax line consultant colleague Chris Holmes. We start as usual with some brief comments on news tax items by myself in relation to direct tax and stamp, and my VAT colleague Rob Edwards in relation to indirect tax. There'll be a Q&A session after each session, and there'll also be a rolled up Q&A session at the end of the webinar. And as a new thing, we've got a little poll at the end of the last Q&A session, and we'd be grateful if as many of you as possible could complete that poll. It will only take a minute or two. So without further ado, can we have the next slide, please? News items. As I said, it's myself and Rob will be talking. I'll start with direct tax. Because the newspapers are absolutely full of speculation about what might or might not be in the budget, I've just hooked out a few interesting and slightly quirky items which we thought might be of interest to everybody and might not have been picked up. One very interesting one concerns employment status. The PGMOL, which is the football referees professional regulatory body, their case about the employment status of Premier League and Football League referees actually got as far as the Supreme Court, who decided, amongst other things, that mutuality does not need an overarching contract. In the past, one possible argument against employment has been that there has been no mutuality from contract to contract. But the Supreme Court has now decided that all you need to look at is one particular transaction, and if there is mutuality, in other words, somebody provides their service in return for a fee or remuneration, then that is sufficient, and no overarching contract is needed. So it's quite an important point about mutuality decided by the Supreme Court, and it will have knock-on effects in other employment status cases. How it will affect employment tribunals, we really don't know, because this was a tax case. But it's certainly an interesting decision. The next thing, the next topic I should be looking at is non-dom tax reform. Well, we've heard all. Sorry about that. This one has run and run. The previous Conservative government introduced, or said they were going to introduce legislation. The current Labour government have said that they are going to go ahead with a non-dom tax reform and also tighten up some of the transitional rules. But as you've probably seen, the newspapers have been awash with possible leaks that the HM Treasury may now be reconsidering, because they think it might actually lose them tax money rather than gain if enough non-doms leave the UK. Are these leaks accurate? Well, your guess is as good as mine, but we simply won't know until the 30th of October. So watch this space. The next topic I'm going to mention as just a random topic out of news items is HMRC's nudge letters. They've been sending a lot of them out recently, especially, and there may have been 4 or 5 sent out in August and more in September. Very recent ones include one-to-many nudge letters about crypto investors. Obviously, they've been looking through the crypto platforms, following up and checking who's been reporting crypto gains and losses, probably more losses than gains. And they've also been nudge letters on non-DOMs who HMRC suspect have not been paying the remittance basis charge, the RBC, when going for remittance basis. That's under the current rules, of course. There have been nudge letters about animal breeders that HMRC suspect have not all been returning their profits. And also there have been nudge letters as reminders to individuals earning more than £200,000 a year who have got other income and need to be filing self-assessment returns. I mean, there's no requirement to file a self-assessment return unless HMRC has sent a letter requiring filing of an self-assessment return. But of course, if there is additional income which has not been reported, there is a requirement to notify. So this is just reminding people earning over 200k a year that if they've not been filing tax returns and they've got other income to notify which has not been picked up in their tax code, they've got a legal obligation to notify. And the last point I wanted to cover was SDLT. Not on a particular case, but there has been a very steady stream, almost weekly, of cases where people are claiming that property is mixed use and therefore benefits from the commercial rates of SDLT, which are very much lower than the residential rates for high value property. I think the practical issue is that there are a lot of repayment boutiques who have been looking through the land registry entries, cold calling on people, telling them that they have a good case to file an amended SDLT return claiming mixed use. And their cases are not always good. Great care should be taken by taxpayers before going along with these suggestions, because if successfully challenged by HMRC, not only do they have to repay the SDLT they've claimed back, but they'll also be facing interest and possibly penalties, and they will get nothing back for the fee of somewhere between 30 and 50% of the SDLT saved that they've paid to the boutique, who may no longer be solvent. So just a general warning when people are approached by SDLT repayment boutiques that HMRC have won most of these cases, although not all of them. Well, that brings to a close my news items on direct tax. So can we have the next slide, please, and over to Rob.
Okay, good afternoon, everybody. Can I just check you can hear me okay?
I can hear you, Rob.
Yeah, that's fine. So 3 things I just want to cover off this afternoon. And the first of those is you may have seen the new guidance. It's called Guidance for Compliance, number 8, or GFC 8. And before, when HMRC had issued these, so there's been 7 so far, and there's only 2 that have been related to VAT. The first one was at number 2, which related to VAT on mixed supplies. We got mixed supplies charged for a single consideration. Number 7 has something to do with football agents, and they're both technical updates. Number 8 is quite far-reaching now, because this is an entirely process-based update from HMRC of what they expect every VAT-registered business to be doing that use invoice accounting. So obviously anyone in the cash accounting regime is excluded from this. And the whole point is to address the VAT gap. So the idea is that there are a number of control points that every business should have. So, for instance, you should have documented processes for the VAT return and potentially automation in parts of the VAT return. That staff are properly trained to do the job, as it were, as well. And the big issue is that some people think it only applies to large businesses. Now, we've heard from HMRC to say actually it applies to every single VAT registered business that uses invoice accounting. And it's applied in a sort of scale. So you're not expecting a small business, you're not expecting to have the same controls as a large business. but it is expected to demonstrate that it has undertaken a review of the processes to make sure that they are compliant for VAT. It is very important to read the documentation. It is quite long. There is quite a lot of it, and obviously BDO can assist you and your clients with this. But particular note is that if there were errors for VAT, and it's shown that there's no non-compliance with this GFC 8, then potentially the penalties could be higher than there would be otherwise. So please do get in touch if you want to talk about that. It is a very important thing for VAT. It's going to be very big, and obviously we can assist with all sorts of things, system reviews, preparing documentation, etc. Second point is the VAT 126 forms. So you may, those who deal with academy schools or say air ambulance charities or blood bank charities, for instance, will be familiar with these forms because it's the form used for businesses that certain businesses that can reclaim the VAT on their non-business activities to be able to reclaim that VAT if they're not registered for VAT with HMRC. And for years and years now, it's been on paper. And I remember 10 years ago when there's a real issue in actually getting HMRC to pay the claims out. So finally, they've actually introduced a new online process for submitting these forms. It was previously, obviously, said previously paper only. But the one thing to make sure, if you've got clients that do submit the 126 forms, VAT 126 forms, the thing you'll need to do on your first claim is to verify the bank details. Okay, so either submitting a bank statement or a letter from the bank with the bank account number on. And in theory, this may speed up processing the VAT 126 claims for those VAT refunds. And the final thing I just want to talk about is it's a case called Visual Investments International Limited. It's a first-tier tribunal case. And it's just a reminder about the danger of not checking you can claim the VAT on legal fees. So just because it's charged doesn't necessarily mean it can be claimed back, or just because it's charged to a certain company doesn't mean it can be claimed back. So this was to do with a legal dispute to basically stop a company from being dissolved or another company being dissolved. The director of the taxpayer had also been a director of this other company until apparently he was allegedly removed as being director. But the whole point was this other company that's been dissolved owns shares in quite a valuable company. And the reason why the taxpayer didn't want that company to be dissolved because they'll potentially lose a right to those shares which they had. So the legal firm providing the legal services issued a number of engagement letters, but they were addressed to the directors personally, not to the taxpayer, not to the company. And the taxpayer argued actually this litigation was to protect its business interests because obviously it planned to provide management consulting services to this other company. Now, the first tier tribunal refused the appeal on the basis there was no link between the litigation to stop that company being dissolved and the possible future management consulting in the future. And actually it found that actually the real reason was to basically to acquire those shares in that valuable company. So it's just a useful reminder that if you're looking at claiming VAT on legal costs, don't assume that you can claim it just because it's been addressed to the company or has been charged to the company. It may not, but you need to look carefully as to whether or not, one, the supplies have been made to that company, and two, are the supplies actually business supplies? Okay, Jeff, back to you.
Okay, can we have the next slide, please? If there are any questions and answers, I can't see any that are coming through. In that case, can we move on to the next slide, please? And Jack Sloggett. Over to you, Jack.
Thank you, Jeff. Good afternoon, everyone. As Jeff said, my name is Jack Sloggett, and I work in the Tax Dispute Resolution Department here at BDO. What that means is I effectively help our customers deal with HMRC. And I deal with a whole spectrum of clients, so individuals, corporates, partnerships. I manage tax investigations, inquiries opened by HMRC, including COP8, COP9, Section 9A inquiries, and Schedule 36 notices. I also deal with voluntary disclosures under the DDS, so Worldwide Disclosure Facility, the Let Property campaign. And I also help clients with liaison with HMRC, such as time to pay issues. The next slide, please. So I think anyone who works in tax knows how difficult it is trying to resolve cases with HMRC sometimes. Sometimes it's no one's fault, but often the taxpayer side and HMRC can get entrenched in a position. And sometimes you see these inquiries have gone on for years and years and years, with both sides sending letter after letter, and it doesn't really move anywhere. Often when you're doing this, you try and get a meeting with HMRC to discuss it. You can't do it for a variety of reasons. Schedules don't meet up, or HMRC don't think a meeting is necessary. I think this scenario sounds quite familiar to a lot of people working in tax. And I think once you get to this position, it's time to consider alternative dispute resolution, or ADR. So ADR has been a part of HMRC since 2013. And recently we've seen it increase in popularity. I think it's quite a strange one. I think when it first launched internally within HMRC, it wasn't that popular. As it's sort of time's gone on, I think people have realised the real value of it, and it is very valuable. So what is ADR? An ADR effectively is a method of settling tax disputes via mediation. And so what happens is HMRC, the taxpayer, and the mediator all get into a room together. And I say room in inverted commas because nowadays it's not often in a room, it's done online. And they discuss the case and the issue at hand with the aim of trying to reach a resolution in a one-day period, which is a fantastic thing. If you think about some of these cases have been going on for years and years, resolved in one day, it's often fantastic. So ADR is great in the fact that it covers the majority of taxes. However, like everything in life, there are a few exceptions. So it's usually minor matters. So for example, complaints about HMRC can't be dealt with in ADR, criminal investigations, debt recovery, late filing penalties are just some of the sort of issues you can't deal with ADR, but the majority of issues and taxes can be settled in a mediation day. So I just want to talk quickly about when you should apply for mediation. And I think, like I said before, when something's been going on for years or the position's entrenched, but I think what ADR works best if the case is right for it. So, for example, there's a few scenarios where the case would be ripe for ADR. So one would be if there's uncertainty over the facts. So if you've been going back and forth with HMRC and you get the sort of feeling they quite don't understand where you're getting at, then ADR would be great. If there's scope to explore potential alternative technical points, ADR again is a great way to sort of discuss that on the day with HMRC. Or if you think HMRC don't actually understand the technical point that you're putting forward, again, ADR is great. And I think the best one is when there's a range of outcomes or there's limited factual information where an ADR day would be beneficial because the outcome may turn on the oral evidence of the taxpayer, for example. There are certain cases where ADR isn't right. So, for example, if HMRC wants to establish a legal precedent, they will not accept that case into the ADR process. Or if the sort of case involves a bit of HMRC policy, again, they won't accept it. And this one here is a sort of minor one, but I thought I'd mention anyway. If HMRC don't think the taxpayer is credible, then it's unlikely that they're going to accept it into ADR because, like I said before, sometimes the best cases will rest on whether a taxpayer can give really credible oral evidence. So at what point during sort of discussions with HMRC should you apply for ADR? So you can apply for ADR any time during the inquiry process. So if an inquiry is still open, then you can apply for ADR. Now, if the inquiry process is closed or about to be closed, then you have to be quite careful about when you apply because only certain times you can apply for it. So if HMRC close the inquiry process and they offer the taxpayer statutory review, and the taxpayer accepts that review, the taxpayer has to wait until the conclusion of that review. Once that's concluded, they have to appeal to the tribunal, and then once that's accepted, then they can apply for ADR. And similarly, if they don't accept that offer of statutory review, the taxpayer then has to apply for tribunal, get accepted in tribunal, and then apply for ADR. So it's a timing point, but hard and fast rule is if the inquiry is still open, then any time. If the inquiry is closed, make sure the application for the tribunal is made first, and then an application for ADR can be made. And then the process of applying to ADR couldn't be simpler. There's an online form that if you just search HMRC ADR, the ADR page comes up, and there's a link that sort of takes you to the form, and then you can apply on there. So what I'd recommend is when you're applying is be really summarize the issues at hand, be succinct, and about what you want to try and achieve as part of the ADR process. What HMRC don't want is to sort of see a long moaning ramble about how long it's taken and why HMRC are full. All they want to know is concisely what the issues are and what you hope to achieve. And then once you're accepted into the process, the ADR team at HMRC it's not statutory, but they have this 120-day rule. So once a case is accepted into ADR, the ADR team will try and resolve it within 120 days, and that goes towards their sort of end-of-year review if they resolve cases within that time period. So if you think about these long-running cases that you just sort of fed up with, and actually there's a light in the tunnel that you could get it resolved in 120 days, I think it's a real good thing to consider. So the next slide, please. So the mediation day itself. So like I said, there's the mediation day, and then there's the preparation for the mediation day. So that 120-day period. So prior to the mediation day, what does that look like? So after you're accepted, the mediator will introduce himself, let himself known, and explain to the taxpayer the process of ADR. And I quickly should mention here, if you look at the third bullet point on the left-hand side, it said mediator from HMRC. So the norm for ADR mediations is HMRC will provide a mediator of their own. It's the taxpayer's prerogative to provide their own mediator, but from my experience, it's not really necessary unless it's a very, very complex case, because even though they're employed by HMRC, the mediators go out of their way to demonstrate they are independent, and ADR as a program wouldn't work if they were siding with HMRC all the time. The mediations I've done, it even seems that the mediator's more on the taxpayer side, and it's making pains to do so. So this is why before the mediation, what we often like to do is have a quick call with the taxpayer and the mediator and sort of put them at ease, so they sort of understand that they are an independent party and they're trying to resolve the case and not trying to back up HMRC. So after the meeting with the mediator, what would usually happen is HMRC, the taxpayer side, would swap an opening statement. And the opening statement is effectively like a 2-page document that summarizes the arguments on both sides and what they hope to get out of the conclusion. Effectively, it's a bit longer than that opening request for ADR. So after exchanging the opening statement, it's usually 2 weeks before the mediation. There's the mediation day itself. Now, I mentioned before, it's not in person. After COVID, HMRC have moved all ADR mediations to online. It has its benefits and it has its drawbacks. I always liked having the mediations in person because it's always quite nice to sort of get to see the HMRC side you've been liaising with over a certain number of years in some cases. But I think actually the online way works, and how we do it is we'll often suggest to the client that the client comes into our offices, we'll have it in one room, so we still have that feeling of being in person, and we'll have HMRC and the mediator on the screen. And what's actually quite useful about this is that if we want to sort of stop the meeting or we want to sort of kick our client on the table, all we have to do is mute the meeting room or leave it, and we can it can discuss a point with the client without having sort of them put their foot in it. Say, often we have clients writing notes to us and passing them on the table with sort of their views on, sort of quite frank views on the inspector from HMRC, which is quite funny. So in there itself, what you usually have is we sort of set it out into sort of phase into 4 separate phases. There's the opening phase where each side will introduce themselves and give a brief summary of the opening statement that they prepared. Then there's the exploration phase. So the mediator will understand a bit about what each side wants. So what does the HMRC want to try and achieve? What does the taxpayer want to achieve? And after that is the bargaining phase. So where you go, well, actually, this is what I'll accept. And HMRC do the same. They try and meet in the middle. And finally, at the very end of the day, hopefully, is the concluding phase, which it summarizes what you've agreed. Now, after the ADR day itself, the mediator will draft a settlement agreement. It'll send it around the parties, and it'll basically be a summary of what was agreed on the day. Both sides can review it, amend it if necessary, sign it, and send it back. And that's sort of how the inquiry or the issue will be dealt with going forward. Now, I should mention that previously ADRs, the way ADRs were marketed was that everything that happened in an ADR was without prejudice. Everything was confidential. You could say whatever you wanted there, and it had no effect. You could end the day not having reached an agreement, and HMRC could use what you said in that day to further the position in the future. So that's how it was. But last couple of years, HMRC have changed their stance slightly on this, and it's got quite a lot of press and sort of tax media about it. So the guidance changed. Now HMRC's guidance says that any tax facts disclosed can and will be relied on by HMRC. And that guidance goes on to say a tax fact is a fact that has legal and technical implications for a taxpayer's liability. Now, of course, when this came out, I think a lot of advisors went to HMRC and sort of asked them to elaborate a bit further. I think a lot of advisors were upset that this sort of confidentiality that ADR was famed for would potentially now changing. And HMRC said, look, tax fact is something that's completely new to them, that they haven't considered before or they weren't aware of before, and they just want to keep their options open to allow themselves to use that. So I think that if everything has been disclosed to HMRC previously as part of the investigation, inquiry, or disclosure, then I don't think there's anything to worry about. It's only when completely new information comes in, then you need to consider with your client how to give that to HMRC. Can we have a next slide, please? So as I've said, I think ADR is a fantastic tool to use when you've sort of got to hit a bit of a roadblock with HMRC. Like, the mediators are independent and they are fantastic at nudging HMRC along, sort of trying to get to a sort of settled position somewhere in the middle. It's very efficient. Like I said, a one-day mediation usually, and it's 120 days process, gives taxpayers and the clients something to look forward to, like especially when something's gone on for years and years and years. And also, I'm not sure how you found it, but in the last few years, I've always found it quite hard to get HMRC in the meeting room or have discussions with HMRC. I think it seems to be a lot of letters, and ADR brings them to the table. You get to talk to them. I think what's one thing that I would recommend when doing an ADR is that when you're setting up, you should insist that the key decision makers are in that meeting, in that room. So when you get to the end of the day, you can have a decision. They don't have to go and get signed off by their boss or the technical specialist. It gets everyone who can make the decision in that room, so it can be resolved in that one day. So like that, there's a stat there for 2021, 22, 80% of ADR cases were resolved. I think that's actually gone up now. I think it's 86% cases in the last year, based on the last stats. And also, like that, we've got a large team here at BDO, the TDR team, and part of what we do is we do ADRs. We have several accredited mediators within the team that have gone the same training courses as the HMRC mediators, and you can sort of act as a sort of a sounding board or mediator alongside HMRC if required. In the next slide, please. So I just thought quickly I'd give you a bit of a success story on how ADR helped one of our clients. So it's a rapidly expanding maritime business, only going on for a few years, but they're doing really innovative R&D. And honestly, I went to their factory and saw it. It was unbelievable, fantastic. And they got an inquiry from HMRC into their R&D tax return, and it was a smaller sort of accountancy firm who were doing it, and they retained the sort of R&D work going forward, but they sort of come out to 2 years with no results with HMRC and resolving this inquiry, which I know, appreciate, does seem to be the case with a lot of R&D inquiries recently. So the company approached BDO, and we suggested going to ADR. Next slide, please. So it says here that previously HMRC had only been corresponding on letters, and the company felt that they didn't understand it. It was a business, it was a really cutting edge maritime technology company, and you really need to see some of the stuff they're producing to believe it. So even though it wasn't part of the ADR day, it was within this 120-day ADR period. We actually asked HMRC, and as part of the ADR process, they came down to their factory and we went through and we got a tour with all the scientists there who explained some of their projects. And then on the ADR day itself, as well as the caseworker, we also had 2 or 3 technical guys from HMRC there who could make the decision. And what was very interesting was that you could see quite clearly that the inspector was quite entrenched and his position wasn't budging. But who did budge were the technical guys who, once they'd heard some of the people were at the company talk, explain about the product they're making, their mind changed quite quickly. And it was really interesting seeing just having a sort of a face-to-face meeting with them really helped. And just suddenly after a quick 20-minute break, they said, look, we agree with you. And they accepted closed inquiry and paid out the full amount of the R&D credit to the company. So I think that is to end with, I think it's the end of the slides. But it can be a fantastic tool to sort of resolve inquiries and really get in front of HMRC and put your point across, especially where you think it's lack of understanding or you just think, I'm not getting anywhere with this. Yeah, thank you very much.
Can we have the next slide, please? Opportunity for questions and answers. I can't see any so far. If there are no, a couple have come up here. One from. Question is, will there be a recorded version? I believe that we do normally produce a recorded version to go out to attendees. So I think that answers that question. If there are no other questions, I think we'll move on to our next main speaker, who is Chris Holmes. So next slide, please.
Hello. All right. Thanks, Jeff. Right. I've been this session here is all on demergers. It's just following up on a session that I did at the annual conference, the TSP annual conference, where it was requested that we did a sort of more of a back to basics on demergers, because the one I did there was a bit more complex. So that's what we're doing. So I'm doing a quick slide talking about the different types of demergers. As background, I am the firm's BDO. The BDO's demergers champion. It basically means I'm the person who all the complex queries on the topic come to within the firm. I also happen to be a tax line advisor, and that's so yeah. So it's so if you have any questions, then you'll probably be referred to me if you call up on the tax line. Next slide, please. Well, I'm going to start off by explaining scheme of reconstructions. If you can understand this slide, then you will understand the concept of indirect demergers, or the principles of them. So the demergers are one of the more complex things that a company can do, but that's all about the other bits you need to do in order to get to the position to be able to do this scheme of reconstruction. Right. So scheme of reconstructions are very simply a company transfers assets to another company, which issues shares up to the shareholders. So I always like to think of that as two sides of a triangle. And if you have those two sides of the triangle, then you have a scheme of reconstruction for direct tax purposes. What happens on the third side of the triangle determines the taxation of the shareholder. So if you did nothing, in law, you have a distribution to the shareholders because value is essentially leaving company A and is going to another company owned by the shareholders. So they're basically extracting value from the company. So that would be a distribution. The way statutory indirect demergers work is they basically say, yeah, we understand this legally, but providing these certain conditions are met, we won't take that point and we will exempt it to income tax. And that means it's within capital gains tax. Liquidation demergers work because this is done through a liquidation, which, as we all know, is a capital transaction. So again, it's within CGT. And then for a capital reduction demerger, it's done through a cancellation of shares and a repayment of capital, and a repayment of capital is also not considered a distribution through Part 23. Sorry, can you go back to the page before, please? Thank you. Yeah, so it's not it wouldn't be a distribution. So again, within capital gains tax. Once you're within capital gains tax, then the various reliefs apply, which can basically make it tax neutral. And from a stamp perspective, although technically it doesn't refer to the same legislation, the definition of scheme of reconstruction for those purposes is very similar, subject to the need for mirror shareholdings, the additional need for mirror shareholdings. Next slide, please. Well, I'm going to work through the different types of demergers now, just to rather quickly, the different types. So the first one is a direct statutory demerger. This is not a scheme of reconstruction. That's just from the slide forward. But this is essentially a direct statutory demerger is no more than a distribution in specie of an asset. So in this case, Oldco is distributing a trading company to its shareholder, and it's just a distribution in specie. Nothing more, nothing less. Technically, it's a distribution in law, but as long as certain conditions are met, it's exempt for income tax and you fall within CGT. It becomes and essentially with the reliefs, the works, you fall within the transaction falls within section 127, which means that there's no disposal by the shareholder, and there's and the new shares and the old shares stand in the shoes of the old shares. Right now, however, the distributing company is making a disposal of the asset that it's distributing, like it would if it's distributing anything. So in practice, the only time we really see these is either when the asset is sitting at a loss, or, which is more often the case, it's shares in a trading company for which SSE applies. So this is normally seen for this is normally only available for shares in a trading company. But it is very simple and easy to do, and you can rely on the revenue clearance to give a lot of the certainty to the client. Next slide, please. Right, the indirect statutory demerger is basically the scheme of reconstruction I showed you above, with nothing specially happening. What happens is providing those special rules are involved, then you meet those conditions, then it's exempt, and through virtue for capital gains purposes by virtue of 122, which is the capital distribution rules, and section 136 of TCGA, which is the scheme of reconstruction rules for the shareholder, it should be tax neutral for the shareholder. In this case, there is the distributing company, although it is making a disposal of the assets, it does get relief under section 139, and it will be treated as a nil gain, nil loss transfer. So whatever asset is being transferred from, in this case, Oldco to Newco, it will be transferred at nil gain, nil loss. There's similar reliefs for corporate intangibles, and there's stamp duty reliefs as well that will apply in a similar circumstances. So in effect, rate tax revision. Now the biggest drawback with both forms of statutory demerger is that they need to. One of the biggest conditions is it needs to be for the it needs to separate. So can you go back to the previous page, please? Don't know why it's flicking. It needs to be the separation of two trades or two trading subsidiaries. So it needs to be trading. So if you're talking about property investments or some other type of asset or company, you can't use the statutory demerger route. The other things that often means you can't use these is there cannot be arrangements in place for a change of control of either company. So if you're about to sell the companies, you can't apply it. And also it has to be for the benefit of the trade and not the benefit of the shareholder. So again, if you're looking to sell it, or even if there's not an arrangement in place, if you're only doing it to put you in a position to sell it, the revenue will probably say, well, that's for the benefit of the shareholder, not the benefit of the trade. So there's a few things there. So often you can't do those. So there's two alternatives which we call the tax efficient demergers. So next slide, please. The first one is liquidation demerger. Effectively, what you need to do is you need to the demerger process itself, as I say, is quite complex. You would need to put you in a position where you've got a holding company and what you want to try and separate below them. It could be you put a new holding company over the top, and that's when you dissolve. Or it might be you just liquidate your existing holding company and have them separated. But in effect, you are carrying out two scheme of reconstructions. In this case, one sub's going to NewCo 1 to one shareholder, and the other one's going the other way to another way. So this is quite, you have no choice here. It's very inflexible because once you're liquidating the company, you have to do two scheme of reconstructions. So that's the one we know. Next slide, please. Capital reduction demergers are the more popular one. The reason I'll explain why they're more popular when I get to the end of this section. I'm setting it out in 3 or 4 slides, in 3 slides. I like to think of these of capital reduction demergers. Well, they do. They have effectively 3 steps. So here we're talking about a trading company with a trade and a property that they want to demerge, and they want to separate the two. Now it doesn't need to be a property. These assets could be different. It could be 2 sets of properties or portfolios. It could be two companies. It could be whatever. But the idea is we've got 2 separate assets here that constitute businesses. Next slide, please. The very first step we do is we put a new company over the top of everything on a share-for-share exchange. So as most people know, share-for-share exchange should be tax neutral. It should be stamp neutral as well, providing there's no future change of control of NewCo 1. So what happens here? What you're effectively doing here is you're creating lots and lots of capital. Now, one of my bugbears here is when this is done and shares are issued at premium. My recommendation to restrict the risks is that NewCo issues shares at least with nominal value at least equal to whatever the asset is that you will be demerging later. If not, actually the entire value of the group that's been acquired. There's all sorts of without going into too much detail, there is risks that you create you create a merger reserve and then the contract is void. So I can go back to the previous slide, please. Or there's a risk that, especially if you don't recognise the premium, that the specialist accounting advice is needed, and so you need to be very carefully giving the right accounting advice. So there's a risk. Do you give the right advice? And the second one is there is a small, very low, it is low tax risk on the cancellation further on that might be deemed a distribution. Whereas if you issue lots of shares and you cancel lots of shares, there is 0 risk. So even why take the low risk? So that's why I do that. Right. Next slide, please. The next step in the second step, the middle step of all of this is basically putting all the assets where they need to be to do the scheme of reconstruction at the end. Now in this case, it's very simple because all we're doing is distributing the property up to the new holding company. But in other cases, you might be doing all sorts of things. You might be transferring assets out of one company, trades out of one company into another. You might be, I did one where we were setting up propco-opcos and all this sort of thing. So this bit can be very complex. And I did one once where there was an 8-way demerger, and we were doing all sorts of things. We were transferring subs, we were transferring trades, we were, it was, shall we say, messy. Sorry, back to previous slide, thank you. So at this stage, so in this example, all we're doing is doing a distribution or a sale to get it up. But when you are doing this bit, it's all your normal transactional tax stuff. So group reliefs is what you're looking for most of the time, but you do have to be careful of degrouping charges or the potential of degrouping charges when you do the demerger. So next slide, please. Right, this is where you do the scheme reconstruction itself. In this case, what we're doing is we're transferring the old company out to a new company, and that issues shares. And in consideration for that, we are cancelling shares in the holding company that we previously put in place, creating lots of capital. So we cancel. Let's say Tradeco is worth £10 million. We previously issued more than £10 million at the first stage, and here we are cancelling £10 million worth of Newco 1 shares. We're then transferring trade in consideration for which we're transferring Tradeco across, and in consideration for which Newco 2 is issuing shares to the shareholders. And that is a scheme of reconstruction and such like, and the relief supplied we discussed. If we're doing a partitioning, then we have to think about, then there's probably going to be stamp duty. Partitioning means that the shareholders above are separated, so that you have one shareholder getting the new company, one getting the old company. So it's very much now the reason I like the capital reductions over liquidations is because I said they're more flexible. If you notice here, we're only doing one scheme of reconstruction. The other bit of the business is staying behind. So it could be that we've actually transferred some assets into Tradeco, so that before the demerger. So if Tradeco leaves, then we'd end up with a degrouping charge. Using a liquidation demerger, you do have no choice because everything's got to leave by reason of scheme of reconstruction. So if it's a degrouping charge. But in this option, if you think, oh, there's going to be, you just swap it around. So you demerge the property in this case rather than Tradeco. So, or you can drop the property down into the subsidiary and demerge the subsidiary. So there's more flexibility about how you structure them, and that gives you a greater opportunity to manage the tax, shall we say, to make it more tax efficient, especially around the stamp taxes and the degrouping provisions. So as I said, that's why I prefer them, is the flexibility. You're more likely to get a better result. You can mitigate the taxes much easier. Right, a couple of more options. So next slide, please. But this is not what we call a tax efficient demerger, and I apologise for the diagram. It was sort of me trying to image it. Effectively, what we're saying is here, which we've got a company, and it's got two sets of assets we're trying to do demerge. Yeah. What we do is we alphabetize the shares so that one share, so they each have rights over one bit of the business, and they don't have rights to the other bit. So in this case, the B shares have the right to the property, including a right to its distribution. Yeah. So the shareholders will reclassify their shares into A and B shares. Yeah. They then transfer their B shares into a company through a share-for-share exchange. So they're still holding the A shares personally. Yeah. So once that's happened, we can simply make a distribution of specie of the property up to the shareholder of the B shares, being this company, Newco. And that effectively puts the ownership of the property into Newco, and everything else stays behind under the A shares. Now, the B shares now have, they're now worthless because the asset over which all of their rights is no longer owned by Tradeco. So you either cancel them or buy them back for £1. Because they have no value. So that sort of just gives a clean break. Now, as with the previous, as with the some of the direct stat demerger that's relying on a distribution as well, Tradeco is making a disposal of the asset that's being distributed. So we tend to see this where that gain is either going to be low, or that gain is or maybe it's at a loss. It's a capital loss. I've seen it more often used with properties which are sitting at a loss, if I'm honest. So I say it is an alternative. The revenue do accept it as being as in that. Now, talking about what we put after we sent them a couple of them, where they finally agreed it was akin to being a demerger, and it was fine. And the motive, and they agree it's not a transaction there. So they do give clearance on this sort of thing. Now, I should say they give clearance now, since we've convinced them. But this is a good little thing. It's cheaper to achieve. It's simpler to achieve. But I said there is a potential for that tax on the disposal, so it's not always right. But the right circumstance it could be. Next option. Sorry, is next slide, please. This is my last option I'm going to mention. This is not actually a demerger. We're only doing a virtual demerger. So what happens here is, and this occasionally happens, sometimes a demerger can be simply too expensive in tax and in fees to achieve, particularly when you're trying to partition property which have got mortgages attached to them. That can be very expensive because it's hard to get to. Is it hard to mitigate the SDLT? So there's always going to be an SDLT charge, and sometimes it's considered too much. So here's an alternative that we have used a few times, including with in a divorced couple, if I'm honest, who really didn't want to know, who didn't want any link together. Basically, we drop one set of assets down into subsidiary A, another one is subsidiary B, and we give alphabet shares, which give sole rights over those subsidiaries and their assets to the particular shareholder. So, and they have no rights to the other one. They also will personally be the directors of the subsidiary, so they have complete control over the subsidiary. And the only time they have to meet, even if they do meet, is at the AGM for Holdco, which, to be honest, more often than not, it's just done through paper. They don't actually hold a meeting, so well they can do, but that doesn't necessarily need to be. So it's sometimes, if it really is the last resort, this is a way of getting ahead. Sometimes used as a temporary solution, and then a demerger is then done sometime further down the line. But that's the way it works. So last slide, I think, is just Q&A. So have we got any questions?
Let me just see what's come up here. Yeah, we've got one question, Chris. Under what section is the property? Which section permits the property-based cost to be uplifted to market value at the point of demerger?
Right. This is okay. This can happen, but basically, normally it doesn't. But if you are to, if in the middle section, you transfer a property or a chargeable asset, capital gains chargeable asset, to a subsidiary, and then you demerge that subsidiary, then the demerger constitutes a degrouping event under capital gains degrouping rules, which is section 178, I believe, off the top of my head. Now, what that means is that there's deemed to be a disposal and reacquisition of the underlying asset, which means that there's a rebasing of that asset. Yeah. Under the normal workings of section 178, that gain is assessed on the company that's disposing of the shares, so the holding company that's doing the capital reduction. But the way it's assessed is it's added to the consideration for the capital gain on the disposal of that asset. So when Holdco makes a disposal of this sub, the starting position is this extra gain, it gets added that consideration. But then section 139 comes along and basically says, I don't care what that consideration is. we're going to replace it with consideration that required to make it nil gain, nil loss transaction. So the answer is the section numbers are, it's an interaction between the way that 178 operates to collect the tax on to assess the charge, and the way that 139 operates. Now, you might have seen a similar concept if there's a disposal where SSE applies, because SSE does a similar thing. It comes along and says, I don't care what that consideration is, it's an exempt transaction. So most people are familiar with it as under SSE. I would say if I'm doing a transaction where I am doing this, I will always add a section 748 corporation CTA 9, might be 10, clearance, which is the corporate transaction securities, because there is a corporation tax advantage arising from doing that. So I'd always put a 748 clearance in alongside all the others, and I'd put an explanation about why we feel it's necessary to put the property into the subsidiary in the first place. The reasons are normally there's multiple tenants, and it's easier to only have to novate all the tenancy agreements once. It could be there's staff involved, there's a business on the property, there's staff, and we only want to 2P them once. So those are the sorts of reasons. But I've come across one now where there really isn't a reason. There's no tenants or anything, so there's no benefit. And I'm really struggling to see why on earth how would we get away with it. I suspect the revenue will just reject 748 if we did it in that case. So, any more questions? Sorry, long answer to a short question.
Yeah, let me see if there are any more.
That doesn't. I would say if anyone does have any demergers, then tax line client, just the easiest thing to do is arrange a Teams call with me, and we can run through. Most of BDO call me up, and we sort of go through the step plan early on, and try and make sure we work out the best way to do it. We do that quite early on in the process. So if you've got any questions if you want any assistance, then just give me a shout, and we can have a Teams. I find it easier over Teams, even if I do have to write up the notes afterwards.
There is another Q&A, not on your area, Chris. There's a general Q&A about what I mentioned in the opening news. Somebody's client here received a nudge letter for a client about overseas assets and income, but with no particular details. It's just a general nudge about overseas assets and income. It didn't even mention which tax years. And we contacted the agent advice line asking for help and direction, but they can't even find the letter. Is there a statutory requirement to respond to the nudge letter, or can it simply be ignored? Well,
for you, Jack, I think.
Yeah, so there's no statutory requirement to respond to it, but I think again, if you phone up HMRC and there's a record of this and they have no record of the letter, I think the first thing I'd think about is, well, actually a real letter from HMRC. But I think more importantly, even if, say, it is a legitimate letter from HMRC, the whole point of nudge letters is to sort of make sure that taxpayers are paying the right amount of tax. And so even if they haven't got a record of it, it may be a good opportunity to sort of just have another look at your client's tax affairs and ensure that the overseas income has been declared fully. I know you've put the client has plenty of overseas income that we've already declared. I just double check that everything is declared, and it may be that you do a disclosure of some kind.
Okay, thanks, Jack. I think that's about all the Q&As. Can we have the next slide, please? Just some contact details of the speakers. Not everybody shown there was a speaker today. It shows all the 4 TSP direct tax and stamp tax consultants. That's Malcolm, myself, Chris, and Sadiq. It shows the VAT consultants, of whom only Rob was a speaker. And as far as TDR is concerned, it shows only our speaker today, Jack. Can we have the next slide, please?